When you're starting your agency, you got a million things going on. You got to learn how to deal with clients. You got to learn how to service clients. You got to learn how to sell. You got to learn how to do marketing. There's a whole bunch of things. Including that mix is dealing with your finances. What type of tax structure should you use? Should you invest your profits at the end of the year? What type of business setup should you use? And to be honest with you, these types of things are better left for a professional. So that's why I brought on Chris Hervishon. His firm works exclusively with agencies to help with things like business setup, tax structures, dealing with accounting, all those types of things that honestly, it's not really good use of your time to do. However, it is a good use of your time to be educated and to know these things so you can make the right and prudent decisions about your agency's finances. So in part one of this interview, we talk about how you should set up your agency's structure, what you can do with your profits, and then a little bit about how to handle your taxes at the end of the year. This is part one of the interview. Hope you like it. Let's get into it. Just kind of get started all the way back at the beginning. Something that we get asked a lot by agencies is, what's the optimal structure for the business? Is it sole proprietorship? Is it a DBA, LLC, S Corp? How do you advise your clients on that?
It's a great question. Probably the most common question that we get. And the first place that we need to start with that is a legal entity structure, and then how you're taxed. Those are two totally different things. Now, if you're a sole prop, that means that you just hung out a shingle, you are your own individual, and you're just operating as a single person, and then that's it. It's very, very simple. It's the easiest way to do it. That there's no complexity to that at all. Where it gets a little bit more complex is when you add another person to the mix. So let's just say it's you and a friend, and you go and you start an agency. There's two owners. Congratulations, you now have a partnership. So you don't really, you have a partnership, two owners, super simple. Now, where we see most agencies land is an LLC. So an LLC is a state level entity, stands for Limited Liability Corporation. And you'll go to your Secretary of State, you'll open up this entity, and now you're operating as an entity. And the reason why you would do that is because it provides you with some sort of a liability protection. Now it separates you and the business. You are two different entities. And so you kind of put up a little bit of a wall between yourself and any sort of liability that the business generates. So that's great. But like I said, it's a state level entity. So it is not a federal level entity. And so what the IRS, which is a federal agency, what they say is, well, we don't recognize this because it's not our entity, it's your state's. So we are going to give you the option of how you want to be taxed. Okay, cool, awesome. So now you have four options. You can be a sole proprietorship, which only works if you've got one owner in the LLC. You can be a partnership, which only works if you've got two or more owners in the LLC. You can be an S Corp, S corporation. So those are the three pass-through entities, meaning that the entity itself does not get taxed. You're taxed at the individual level. So sole prop, partnership, S Corp, and then your other option is a C Corp, which is like your more traditionally thought of corporation, and the corporation is going to be taxed at the entity level. I think we've seen that maybe once from an agency perspective, where that made sense once. The vast majority of the agencies that we're working with are S Corps. So we have a couple different partnerships. Now, what the optimal tax structure is going to be for you is going to be very, very dependent on your situation, how you operate the agency, how much money you're making. There's a whole host of factors that go into that. It's not as simple as, well, you should do this. There's a whole lot of considerations that go in there. But like I said, the vast majority of our clients are going to be S Corps. LLCs tax as S Corps. S Corps isn't really a thing. That is a tax election. It's not like a real thing.
I was going to say, so the way that I'm set up is I have three LLCs. I have a consulting agency. I have the Blueprint Training, which is an LLC, and then I have Weber's, which is an SEO agency. That's an LLC as well. But then my tax accountant, actually looking for a new tax accountant, so we can talk afterwards. But my tax accountant set up a new corporation for myself as an S Corp. Right. So then those three LLCs pay me into my S Corp. And then out of my S Corp, I believe I pay myself payroll into my personal bank account. Right. So I have 5 bank accounts, one bank account for each LLC, a bank account for my S Corp, which is also business, and then a personal bank account. So the way that he explained it to me, and I'm sure you got a lot to say about this and agree or disagree, but the S Corp allows me to not bypass, but minimize payroll tax. Is that correct? The way that works, and everything else passes through. And this is also a challenge for me because all those companies that generate profit passes through to my personal income. Am I correct on that?
That's correct.
Okay. Yeah. So that was actually kind of an awakening for me. So in terms of that profit, Another question that we get a lot too is, okay, like let's say an agency has 100 grand left over at the end of the year. How do you recommend that they deal with that? Should they reinvest it? Should they pay it out as bonuses? Should they take it themselves? Is there any tax benefits around that at all? Or how do you suggest that agencies deal with that profit at year end?
Yeah, that is such a good question. And again, it's fairly nuanced. And this isn't total disclaimer. Everything I say is not individual tax advice, yada, 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 right? We have to say that out loud. Okay, so let's just say that you're operating as one of the pass-through entities. So sole prop partnership, S Corp, and you have net income at the end of the year. And let's just say that net income at the end of the year approximates how much cash is in the bank account at that point, right? So that's kind of the question, like, do I take it out or do I leave it in? What do I do with it? So if you're a pass-through entity, you're going to pay tax on that regardless of whether you take it out of the business or not. So that's already been taxed. That is water under the bridge. It's not even worth worrying about. Now, the conversation about whether or not you should take it out depends on what you need to do in order to operate. So we always recommend that you have a cash reserve that's between 2 and 6 months of fixed expenses. And that's our opinion. That is our preference. And the reason why you do that is so that you make sure that if you have some sort of a slowness, which we're seeing a lot of now, slowness in revenue growth, or here's another great example, you have increasing wages that are increasing at a relatively fast clip, or some sort of unforeseen expense, or a big client leaves or whatever, you have that cash reserve so that when the agency becomes less profitable, you have some sort of a fallback. You have access to cash where you're going to make sure that you're paying your rent, you're paying your people, you can pay your vendors, like that sort of stuff. So always have a cash reserve. It's 2 to 6 months. So let's just say that you have an adequate cash reserve and you still have all this extra money. Now, the question then becomes is, what are you going to do with it? And then what is your opportunity cost, right? Because you've already been taxed on it. It doesn't, doesn't matter whether you take it out or not. So do you have to go hire more people? If so, then you should probably keep cash. Do you have to go make investment in technology? If so, then you should probably keep more cash. If for some reason do you have agreements with clients where you're fronting a lot of their expense, well, then you should be keeping more cash. Are you looking to go buy a building that your agency is going to move into? In some places, that's still a thing, right? Post-COVID, you should be hoarding cash. Now, if you have some sort of investment or business opportunity on the personal side, or you're going to go make a home improvement or like whatever, like you've got some investment on the personal side, you don't need the money in the business because you've already got your reserve and you just kind of in a stagnant state. There aren't huge growth opportunities that you're going to need cash for. Then take it out and go do something else with it. That's the opportunity cost. Do you have a better option personally to utilize the cash, or do you have a better option in the business to utilize that cash? And do you have an adequate cash reserve? Those are the basic considerations that we think about.
So when you say you're already taxed on it, meaning I paid tax at the personal level, and let's kind of scrap my example, because I think my example is a little bit more because I have multiple streams of income, right? I think my setup from what I understood, and I'm not a tax professional either, I'm just trying to relay the information that was relayed to me. It's always a little bit confusing, but I have multiple streams of income through multiple businesses. So this is what I was explained is my act, like kind of like you said, it varies case by case. Most of the people watching this will be one business, maybe a partner, maybe not a partner. So we'll just say, generally speaking, probably going to be an LLC setup. So let's say they have $50,000 cash net profit left over at end of the year. Does the business pay tax on that, or do they as individual partners pay tax on that? How does that, because it's not the same situation as mine, right?
So remind me, you had 5 different entities. The S Corp was kind of at the bottom, the way that you're...
Yeah, they all feed into my S Corp. I basically take distributions from the way that all my LLCs are set up is that I don't take a salary from any of them. I just take distributions from each one of them.
Yeah.
That then pools up in cash. And then from that cash, I pay myself basically 75 grand a year in salary minimum amount to pay payroll tax on that, which I then take the rest of what's left over as a distribution into my personal account, which bypasses payroll tax, right? I still pay income tax. Yeah, I still pay income tax on it, a shitload of income tax on it. But it saves me, I don't know how much it actually saves me, but there's a lot of moving of money around in accounts. I know that on a regular basis. But if we were to go back and say, okay, I'm setting up an agency. I set up an agency this year. I set up an LLC. It's just me. We did 100 grand in revenue this year. I got 50 grand in profit left at the end of the year, right? That's the business's profit though. It is owned 100% by the owner, assuming that they have 100% equity in the business. Let's assume that they do. Who's paying taxes on? I always get a little bit confused about this. Who's paying tax on that? Does the business have to pay tax on that? Or does that all the profit just fall on the individual to pay taxes on it because they own 100% of that $50,000 in the business account? are they then liable personally for that, or does the business pay tax on that $50,000 profit?
Really good question. And this is where it depends answer, and this is where it gets fairly nuanced. So let's just take this from a federal income tax perspective for the time being. From a federal tax perspective, of those 4 options that I gave you, sole prop, partnership, S Corp, C Corp, the C Corp is the only entity that will pay federal income tax. Okay. So that you're going to file a tax return under all 4 scenarios. Under the sole prop, your tax return is going to be the same as your personal tax return. There's no additional tax return. Under the partnership, you're going to file a partnership income tax return, but the partnership is not going to pay tax. You are going to pay whoever the partners are going to pay their proportionate share of tax. Under an S Corp, the S Corp is going to file an income tax return. But again, the shareholders are going to be the folks who report that income on their personal return and pay tax there. So the S Corp from a federal perspective is not going to pay income tax. The partnership from a federal perspective is not going to pay income tax. Only the C Corp from a federal level is going to pay the income tax. It gets a little bit more difficult when you get to the states and income tax. Some states tax those entities, some states don't. A great example, if you have an S Corp in California, you're definitely paying income tax in California. That's, it goes state by state, it varies. Now, under those first 3 options, the sole prop, partnership, S Corp, the 2 that file tax returns, they're going to generate a K1. Just like if you got like a 1099, maybe you had dividends, interest, something like that, you're going to take that K1, you're going to report it on your individual tax return. When you go and file your individual tax return, you're going to have a bill, and that's when you're going to pay your tax. So it's not the entity itself that's going to pay the tax. It's going to be you personally under those options.
The K1 is the shareholder's income statement.
Yeah, exactly. Mm-hmm.